Welcome, everybody. Another week, another Ask Me Anything happy hour. We are going to get together like the Brady Bunch to answer your questions. And you know what? What you've got to do right now is get those questions ready. We will be right back after this. All right, folks, we are back at it. Another week, another Ask Me Anything happy hour. We're waiting for you to put your questions in. I know everybody's always a little slow with questions. So what we're going to do is before we get into your questions, we're going to go around the block here, starting with Mr. Snaggy up there in his new fancy blue office. It's like Oompa Loompas.
What's up, guys? What's up, everyone? Welcome back.
Can't hear you, Steven.
I can hear him.
You being sarcastic?
I hear you.
Oh, you can?
Yeah.
Oh, what's up, Craig, Mr. Tech Guy? Can you still not hear me? This is great.
I can hear you.
Hey, Craig, you know that funny little thing on your face right now? I'm just kidding. Oh, what's up, guys? So just having fun here. Was sick last week for the first time in quite a few years. Right, literally couldn't get out of bed for a couple of days, some kind of flu bug, but glad to be back. It makes you really appreciate your health and appreciate, just being able to wake up and feel good every day. So it's one of those things we talk to a lot of clients about when we're talking about insurance policies, especially those that can't get them because of health-related issues and things of that nature. But just really made me do a lot of thinking last week. So it's good to be here. Happy to be here. It's been a fun day today. We had a good What the Up this morning. I thought Wealth Webinar, Chris did an incredible job going through what that looks like, moving money with a policy and some different options. So get your questions in. We'll make sure to answer them all. And I'll pass it over to Craig. Can you hear me yet? Maybe not. Linus, it's up to you.
Oh, it looks like Craig's.
Hey, everyone. Linus Knoll here from Hopkinsville, Kentucky. Always helping people understand and start with the infinite banking concept, which is using specially designed and engineered whole life insurance policies with mutual companies that pay dividends and to change how you move and flow your money. So this past week, I helped a grandparent obtain whole life insurance policies on their grandchild and great grandchild. It was really cool to be a part of that for that 3 generation out of legacy transfer. So that was cool. And just very recently in the past week as well, I've been helping my father-in-law and mother-in-law to explore options on what they can do with policies on themselves to begin practicing the infinite banking concept. So that part has been really exciting. I've been dropping, some tips and nuggets with IBC with them for years. So it's great to see that come around.
Congrats, brother. That's huge.
Yes,
Awesome.
definitely is. So Craig, now that you're back, go ahead.
I mean, I was here. I just couldn't hear anything. So I'm back. Whatever the internet gremlins went away. So here I am, Craig Yenny here, just hail from the south part of Denver, Colorado. And, I was thinking we've got Thanksgiving coming up here, next week. And I've been telling all sorts of Thanksgiving food jokes lately. And Gina finally said yesterday, she goes, enough with the Thanksgiving food jokes. And I said, what do you want me to do? Stop cold turkey? But anyway, I'm going to go ahead and leave that dad joke in there for you, Linus.
Love it.
And I'm just going to pass it right on down to Jason.
Thank you, Mr. Yenny. And I actually shared in another group today, another place I got to present and share with our peers, that I used to be the dad joke guy, but then there's people that are in my ecosystem now that I don't even try. I mean, I've taken any bit of funny I had, and that's it. I can't even keep up. It's not even a fair game anymore. It's like a rookie playing with the majors. So
I don't think that's true.
It's true. It's true. I promise. My favorite one is, what do you call a big pile of cats? A meowing.
There you go.
That's it. That's it. So over to thank you for being here. Put your questions in the chat. We're going to have some fun with all of you today. And over to Miss Shauna over here.
Hello, everyone. Been a good day. The wealth webinar was really cool. What the F happened was great too. So just been a quick day. Wednesdays go by so fast. So it's already Ask Me Anything time, and we're ready to answer. I threw a question that I want to ask in there too. It's not for me personally, but a question. So
For a friend.
yeah, I'll pass it down to Brian.
Hey, everybody, Brian Fauci up in North Idaho. Up where I live, one of the biggest things is you got to get ready for winters, and you have to make sure your equipment is running. We have obviously tractors and all that kind of stuff. And I've had a bobcat or a skid steer sit in my front yard, stuck there for the last, 9 months. Somebody came over today, and they got it running. I was so excited. It has a huge snowblower in the front of it. He left. I hopped in it, was taking it back to our barn to park it, and it started making a knocking noise. Very bad, very potentially expensive. And so I have this policy over here called Infinite Banking. It has about 6,000. It's one of my smallest policies. And I'm like, I might have to be tapping into that thing to get a new motor, decent motor for a Bobcat. So I always have a policy sitting over somewhere for emergency funds or unforeseen expenses. And that's exactly what this one is for. I hope I don't have to use it, but if I do, hey, it's not going to come out of my pocket per se. It's going to, or my savings in my cash, it's going to come out of my policy. So always be prepared. So there we go. So over to Tess.
Hi, I'm Tess Hulak, and I'm going to have to do that too. I have a couple snow blowers. I better make sure they're ready for the season. My dad leaves his extras over here. But what I'm going to say today is the team has let me have my MSTV episodes from earlier this summer. So anyone who would love to see MSTV, I have about 6 episodes on my personal page. So go on over and check them out. Now on to whoever's next.
I do have one question for the group here. So 3 of you all have microphones, showing in your view of doing these webinars. 2 of you do not. So I wanted to ask those of you that do, have you ever thought about using one of those microphone flags, like one of those boxes that puts on there with like your logo on it? Or do you like the plain, clean look?
I don't know what you're talking about.
Okay.
Like
Glad you asked. Let me show you. So like these things right here, like you can put like a BYOB or Founding Fathers logo or whatever.
So I can't hear Steven and I can't hear Shauna, so I don't know. I might have to leave and come back.
Selective hearing.
I was just hearing you guys' opinions on.
Honestly, I can't hear him.
I had one before, and I ended up getting rid of it because it felt like when I was looking at myself, it felt like it was too big and taking up too much of the screen. So I have this one sitting over here on my desk. It's just sitting away from me, and it works great. So
yeah. Like I took mine out of the view too. Like mine's sitting here, but.
Oh, I have that one too. Well, not now, but I have it somewhere else.
All right, we can get to it.
Who's echoing?
Everybody.
StreamYard's a mess right now.
And why is there 2 of us? Anybody?
Is it like that on Facebook?
I think we just see that on our end, and it's actually like a large screen view and a small screen view for mobile.
Ah, okay. So great for showing us both.
I'm going to start with the question that I had asked earlier, or someone had asked me earlier this week. So Chris, Dave specifically in our office was asking, they just did something with their mortgage where they reduced their payment by $500 a month. And they totally understand that, this would be a really good place to put that $500 that they kind of just got, that they were already spending, into a policy. But their question was, what happens if you what happens if you lose your job? And so I want to talk about those things, because I think everybody has those concerns. Is I have the means today, but what if I don't have the means tomorrow? And what options are there if I start with where I'm at, but things change? Does that make sense?
Yeah, it's a great question.
It's definitely a good question. It's one I think about a lot too, because I've been intentionally trying to get fired, but I just cannot seem to get fired. Trying hard though. But when we build the policies, we build them with a lot of flexibility, and the flexibility is really determined by the client. So there's the P way, Okay. That we put on the policy, that's flexible. So if you lost your job, let's say, I'll just use $1,000, keep a simple math, 1,000 a month. So if you had a policy that was 1,000 a month, and of the 1,000, 700 of the 1,000 was going to the paid up additions rider, or they call it PUA, you could stop that at any time and then restart that. There's some rules, but like just keep this high level right now. You could stop that $700, which would leave you a $300 base premium, which the $300 would have to be deposited into your policy to keep it alive, depending on where you're at, because there are policies, if it's been around a couple of years, you have dividends. You can always apply dividends to that base premium to help reduce it in the event of losing a job and you needed to go from 1,000 down to whatever, 150. You might be able to get that by dropping the PUA for a period of time until you get back on your feet and get a job, and then using the dividend to offset the base premium amount, which would again further reduce it down to the bare minimum.
Yep. One of the things too, Chris, have you ever done a video on like the origination of the policy loans in the policies?
What do you mean by that?
So like back in the early 1800s, why they started doing policy loans?
Oh no, I didn't. And I read stories on that. I've never done a video on that.
It's great. So and I tell the story quite a bit. So why did they start doing policy loans? Well, keep in mind, this is back in the 1800s, so very different time frames, but a lot of people had cyclical income, the reaping and the sowing. So you had good times and bad times, and people had life insurance just like they do now. But if you have a bad time, what do? Well, you start cutting expenses. You would cut your policy, and all of a sudden they'd have policy lapses or surrenders. And that's bad business for the insurance companies. So as I understand it, back then they said, well, wait a second, if we have this cash value or death benefit that they're building up here, what if we allow them to borrow a percentage of that death benefit based upon how they funded the policy to date, so they can borrow from the cash value to pay their premiums during the bad times and pay it back during the good times, the reaping and the sowing. And so the reason why policy loans exist is for that question right there. That's crazy. To make sure that you can pay premiums when you have a bad time, pay it back during the good.
Brian, that's such a strong point. That started all the way back in 1848. Like that's the history. Yeah. So like if you think that Americans had better financial habits back then, maybe not. And the purpose, and think about it, if you think it from the mutual company's perspective, the purpose of a life insurance policy is to protect the family in case you have a catastrophic death, to replace that income so the family can get back on their feet. So naturally, the cash value is super valuable. And it's something, well, the insurance company's like, well, hey, in 1848, we don't want people surrendering. So let's let them borrow against this cash value because we're safe. And if they pass away, it'll come out of the death benefit. So like if you start thinking about the why mutual companies do it, it really helps you put all the pieces together to use this as a bank.
Yeah. And I always get the question too was, well, why do life insurance companies allow you to borrow from the policy? So that you don't surrender the policy. That's good business for them and for you. That's actually the reason why it originally existed. Now, yes, we have morphed it over the years to also be a banking strategy, which is the Rockefellers did that in the 1800s too. But it's really cool. That's a good question. A good thing to ask the why. And then, the reason behind it makes sense.
Yeah, and that's a great reason to when you're using a policy for infinite banking is to not borrow the maximum and keep some there for your reserves. If you're not holding reserves somewhere else, is that can be some of your reserves as well. And so that helps protect against unexpected expenses, as well as something really unforeseen coming up where you can't pay the premiums. So yeah, you could borrow to make the minimum premiums.
Your IBC emergency fund. Welcome to the party, Mr. Kovacevic.
Oh, don't even get me started. You know what it was, right? Technology, of course.
Who let him in? What's going on?
Everybody's having tech issues today, I swear.
Mm-hmm. I had no tech issues. When you log in at first, you have to, if you want to broadcast it, you have to sign in. I just didn't get in here fast enough, Chris. So I was actually technically good today.
All right. Shane's got a question about the Eckerd Oil deal from the Wealth Wednesday webinar today. Which investment is for tax savings and which is for the immediate cash flow when using a self-directed fund? I think self-directed was for minerals.
Yeah, it's a great question. It's one I always used to screw up to. The drilling The one I was referencing today, the drilling ones are the ones you do for tax deductibility. And that's the one that he was saying in a 24-month period, they've pretty much given all your money back on every one. So that's the drilling. You would not do drilling from an IRA. Then the minerals are the ones that's 12%. That one you would do from the IRA. And then the other one I was talking about, which maybe confused people because it was kind of like a one-off, was I lent money to Troy Eckard for that building that they were doing the video from. So that was just a promissory note at 10.25%. So that one I don't think is available anymore. So there's technically usually just mineral, which is think income, think interest rate income, and then the drilling, which is for tax deductibility and future investment growth.
Thank you for clearing that up for Shane. Shane always has good questions.
Oh, yep. And then Connor, I think, said, I believe the oil pump was tax savings. The 10% investment was on the loan.
That's the guy you met in Nashville, Chris. Remember him?
Connor.
I do.
We talked about that last week.
All right. Lorraine is saying whole life policy that we purchased for me, my husband, and my 3 kids. I desperately need help with infinite banking. Went furlough twice, and we are stuck in a deeper hole from the first furlough. Whole life policy that was purchased for me, my husband, and my 3 kids. Let's say, do we know if it was infinite bankingly built?
I'm wondering if she's asking about that being a possibility or if she has policy.
Well, it's kind of what we just went over. You know, the furlough, I would assume, went through furlough twice, meaning you were let go from your job twice or kind of on hold on your job twice. Is that?
I didn't know what you meant. Maybe the government layoff. I didn't know, right?
Furlough is a layoff.
That's how I was reading it. So we need a little bit more info, Lorraine, probably to give you a clearer answer. Because I know this is definitely, what's keeping you up. So,
I mean, it's kind of like what I just said for the first one on, like probably the thing you'd want to do is go get on the phone with your I-team specialist, whoever that is, Ethan, Larry, Jerome, or Wes, and ask them to figure out what your lowest premium could possibly be on those policies. And then we can, cut PUA for the time being, and then see if dividends could help support some of the premiums. And that's going to get your payment, much lower, but give you the ability to go back up, when things kind of come back. Let's see, that's my question. Can I government shutdown? So, okay.
Yeah, I wonder if they're in process.
I thought that was all done now. I guess they're just not, the checks haven't started rolling, but because you're furloughed, you get all the back pay, right? So when that back pay comes, you should be in good shape. So it almost sounds like I wouldn't do any knee-jerk reactions, because if it's the federal government and you're just waiting on those paychecks, it's probably just a time frame. But I'm sure you're feeling like the world is coming down on you, because obviously just because your paycheck stopped doesn't mean bills stop. I've been there. So you might want to just, I'm sure. What insurance company was it that said any federal employees they were going to, Lafayette Life. What did they say? And I don't know what policy do you have, Diana? Is it, or not Diana? Sorry, who was that from, Shauna?
Lorraine.
Is your policy with Lafayette Life? So anyway, go ahead, Linus, about the
it's more on an individual basis. Have the client, the policyholder, call in and explain their situation, and they'll work it from there. Because their typical grace period is not much more than 30 days. But for that situation, they can definitely give a longer grace period.
So Guardian, huh?
Let me find out about Guardian for you real quick. We'll go on to the next one. Lorraine, I'm going to get an answer on Guardian. I'll be right back.
All right. Thank you, guys. And we'll just move on and we'll come back to that. Shane saying, curious if there is typically a 30-day window before tapping into my new cash value deployment for my annual renewal.
Depends on the company.
It should be less than that.
Yeah, I said 15 days with Lafayette.
And probably depending on how you paid. If you paid by check, you've got the mail time and then the clearing the bank. And if you did it by a wire, it would be quicker.
Doesn't it also depend on the amount too? I've heard that it depends on the amount, because if it's a large amount, they might put a different hold on it to make sure that it does clear the banks.
Good point.
So I've had someone get it like within like days before.
In the past, like years ago, I have an annual one, and I was anxious, wanting to use it. I paid it, let's say, like 30 days before the actual due date, because I wanted to get it in there and get it out of there. And it didn't really even post until my premium was due date, even though I paid it ahead of time and early. So I think it also really matters on that specific date that you're renewing on, as well as all those other factors.
Yeah, it just depends. It's always within the first 30 days.
Yeah, Shane said down there ACH, and it's with Lafayette Life. Their typical hold is going to be 14 days. So on the 15th day, you can request a loan based on the new liquidity. If you want to go quicker, there is a bit of a process. If you can show them where that transaction has actually cleared your bank account, they may be able to cut the hold short.
Great. And Lorraine gave some more information. She said, I want to see if I can use my whole life to pay off my debts. Could I email you my policy?
We could. Who's the I-team specialist? Do we have the ability to pull that up, Linus?
Give me a minute. I should have been doing that already.
Okay.
I'll go into another question right now.
Policy name is life paid up at 121. And did Lorraine got that? Did you get that through us, or was that just?
I don't think so. I'm not finding that name.
Oh, okay.
Because that was a Guardian, wasn't it?
I mean, the rule. Once Patrick gets back to me on the furlough rules with Guardian, that'll be the first thing. If you have cash value, Lorraine, yeah. I mean, just who wants to take the email?
So I think I know Lorraine. So go ahead and have it send it to me. So Lorraine, so Brian at chrisnoggle.com. So I need to look real quick. My name's assigned. If it's the same, unless there's more than one Lorraine Marquez, I'm assigned to you. But
oh, there you go. How about that? So yeah, email that over to Brian, and then we'll take a look at it. And then by that point, I'll have a text back from Patrick about what Guardian's standpoint is on furloughed federal employees. I know most of the carriers, like Lafayette actually put a press release out saying that they were willing on a case by case to, help the grace periods just to help people out. Most of the insurance carriers are probably willing to do something. They might not make it public, but they probably would under circumstances. This is a good one. Do you want to read this one, Shauna? B. Marsh?
Yep. I'm having trouble getting a policy. My 40-year-old son. I'm 72 years old. He is in excellent health, but the insurance company wants John as the primary holder instead of me, and he lives in New York.
That's
hey,
why.
Bill, how you doing?
It's because it's this shitty state called New York that I live in.
Well, it's not just this one. This is we're having this with a lot of clients, and obviously I know Bill because he's my client, and we were texting earlier today. So what's going on with right now, and this is for kind of everybody, is that there's some national rules around life insurance, and they've changed them here recently. And one of the consequences of those is that they're wanting, if you have a parent trying to get a policy on an adult child who has income, is on their own, they're asking what is the insurable interest that the parent has on the child. And what that means is, what they're really saying here is, and this is weird to say this, but if the adult child passes away, what is the financial loss to the parent? And in some cases, there is none. So they're asking, why are they getting the policy? Why is the child not getting the policy themselves? The adult child, by the way. And so that is a legit question, to be honest. And so we're working with the insurance companies trying to figure out the best way to make these things work. And so, Bill, I do have some options that we can discuss, obviously offline a little bit about this one, but it is definitely becoming a bit of a challenge. And so, but insurance rules do change. They do change them over time, and this is one of the things we're running into. I have this right now with 3 or 4 clients.
Yeah, I can see that. I can totally see that. But I mean, what about? And I'm sure this is one of the options. What about John being the owner, and then after issue, you just change ownership?
Same issue, same question.
Really?
Yep. I've been denied that already. And they ask the other thing to keep in mind is on the application, they do ask that question: is there intent to transfer ownership? And if there is an intent, we got to say yes. They're going to ask the exact same question.
Yeah, they've been
So
denying.
we as agents have to be careful about this.
They've been denying ownership transfers lately.
Well, this is a new one. That's interesting. Thanks for letting me know that, Brian.
So an option that I have not confirmed yet, so this is not advice or a final answer. If you are going to put the policy into a trust and the parent and the child are both trustees in the trust, that might satisfy the insurance company's requirement, and they both potentially could access it because they both own the trust. But once again, that's going to be an attorney question.
Stephen, we were just texting about this. I can read that text that you just kind of sent, which was, life insurers have a regulatory and fiduciary responsibility to ensure that every policy is issued and maintained with a legitimate insurable interest and within the intended spirit of insurance. When ownership changes occur soon after issue, they can appear inconsistent with the original purpose of the coverage, and it may signal potential stranger originated life insurance or SOLI activity and investor driven transactions, both of which are prohibited in most jurisdictions. Key reasons for review are, I can stop there, but it says we don't assume wrongdoing, but we verify intent and legitimacy. Our review may include confirming the new owner's relationship to the insured and their reasons for transfers. Blah blah blah.
Yeah. Now, a couple of things to clarify on this though as well, because we're obviously all learning, so we want to make sure we're sharing that knowledge. So you have an insured person who's the insured body on the policy. You have the owner of the policy. The owner can be different, and obviously in what we're talking about. But you could also have a payor. The payor is a person that is responsible for the premium, but is not the owner of the policy. So you can always do that. So a parent could be the payor of a policy where the adult child is the insured and owner. The challenge with this one, though, is that the child is the only one that has actually true ownership access to the policy to use it as accordingly for infinite banking. So that's something else that we're kind of working on as well. And Francis down here says, wait, so a 72-year-old, me cannot put a policy in the name of a youngest grandchild but still own the policy? That's potentially a challenge right now.
That one you can because it's a grandparent's policy, right? But it's going to be a very, very small amount. So
and you need consent of the parents.
Yeah. Correct. And it depends on the age of the child, though, because if you're 72 years old, is your grandchild over the age of 17? If they're over the age of 17, then the same issues come into play.
Well, Brian, in that case, it doesn't matter because it goes by the grandparent gifting guidelines. So it doesn't matter whether it's an adult grandchild or not. But something to keep in mind is that they then want all grandchildren insured equally under those grandparent gifting provisions. But yeah, like they said as well as small policies for that.
Yeah, up to $100,000 typically, death benefit wise, you can do that. Now I've run into this though, if the grandchildren are over the age of 17, that whole thing about getting policies on all of them gets kind of murky a little bit. I've had it where you have an underage grandchild and an adult grandchild. And the insurance company said, oh, we want equal coverage. I'm like, but you can't even design policies to be equal in that scenario. And this is One America, by the way. And they said, no, actually, Brian, you're right. Yeah, we'll do separate policies and they don't have to be aligned. So it depends on the insurance company. It depends on the relationship that we have with them and the conversations we have, because it's not black and white, cut and dry.
Wait. You're saying this is specially engineered for every single situation all the time, forever and always, and things change in life? Holy smokes. What are we talking
about? Pretty crazy. So yeah,
No, it's also now we're getting to this depth. Like, this is really deep conversation, and it's probably a lot of people are like, "What the heck are they talking about?" Just if you hear us, what we're saying is we are so focused on solving your problems and finding ways to help you get what you want. And we're going to all the different carriers, all these giant mutually owned companies. They're all profitable every year for well over 100 years, and we're going into the weeds with them. We're building relationships. At the end of the day. Like, if you have someone that, really wants something big and you have a good story, I mean, this is what we talked about an hour ago. It's really how the story is being presented. Doesn't make sense from the mutual company's perspective that the story makes sense for protection, for other things, and it all kind of aligns nicely. Like, it's really our ability to present it. So the clearer people are what they want, what they're trying to do, the more clear we can be on the questions we're asking.
When you're in these situations, because I'm just thinking from my perspective as like being a mother, like I can see my mom having an insurable interest in me, because if something happens to me, you know, she would have to step in for my daughter. So so things like that. I wonder if we bring in, like, yes, I'm an adult child, but my obligations get passed onto my family, you know, things like that.
Well, that's how you would present it in the cover letter, right? You would present that exact scenario.
Yeah, so that is insurable interest. In my cases, there are no kids, the grandkids to create that, and then additionally, they have spouses that are would take that as well that are in the household. So it's definitely specially designed and specific to each case.
Interesting. Okay. Justin saying, would there be a replay coming out for today's webinar? I missed it. Yes. Typically, Wealth Wednesday webinar gets published on Saturdays on the YouTube channel. So every Saturday video, just know that was likely the Wednesday webinar.
I thought he was talking about this right now, and the answer is yes too. But I was like, "You're here, man. You need a replay. We're so good." Like,
rewind.
I Chris in the Wealth webinar. Is Chris frozen, or is he just very stoic and thinking right now? What's happening? Okay, he's chilling. Okay, just check it, man.
All right. Diana saying, my husband Steve and I had a conversation with Chris back in 2017 or 2018 about a rental property in Clarence, New York. Since then, we set up an IBC with One America, and we would like to do more work. And then it does say, are we able to do a different agent? So I don't know if that means that they were set up with you, Chris, and to work with a different agent.
I mean, yeah, you can work with anyone you want.
Yeah. All right. Robin saying, are you guys still flipping forklifts?
I'm not, no. My last one got bought. Do any of you guys have any forklifts left?
Not right now.
I think he bought most everybody out. I think anybody's lift that didn't sell, if I'm not mistaken, either they're still trying to sell it or they just kind of got their money back on them. No, we're not doing them anymore. They slowed down.
Yeah, I think the model is still there. If you can call them or whatever, get in contact with them and figure it out from there and just find out what's new. And Craig is saying, is it best practice to pay yearly base premium before PUA, or is it automatically done that way?
The base is what has to be paid always, right? So like if you are needing that flexibility to go down to that kind of manageable floor, that is going to be the base plus whatever, depending on how you're paying, whatever it takes to keep the PUA attached if you want to add back in.
Yeah, I always explain it like this way: base, term, $10 PUA, and then rest.
And then Diana came back and she said, we got the policy from someone else, not from you. At the time, we did not know you were doing IBC. I don't know if you really were. I think we just got into that in 2017 or 2018. I think at the time we were just talking about it, not necessarily doing it.
Got it. Yeah, you can. It's called a servicing agent. Like there's a servicing agent, so you can change that at any time. So you could literally call One America and get a servicing agent change, and then just change it to anybody you want. If you wanted me or any of the folks on here,
she may have gotten it through Brent back then.
Yeah, could have been. Yeah, very well could have been. So if that's the case, just wait. But yeah, you could just change that over. Piece of cake.
Can we drop the round robin link for her to be able to book a call with someone on the team?
That's probably a really good idea. Yeah, we probably should do a review of it anyway.
Yeah. Well, also it should be under the Brent Kessler agencies first, so that would be us anyways.
Yeah.
And then to that point, if you go to mentors.beyourownbanker.com, that's for if you want to have any of these conversations, if you want to get started with a new policy or get started with your first policy, that is where you go to get on the calendar for a 45-minute call.
I'm just like sitting here trying to remember what house that was in Clarence, New York. I've done so many, I can't remember. That's what I'm stuck on.
Oh, and we already answered that. Antonio is saying, hi team, what is the cost for the vault?
So the vault is $47 a month. And there's a couple options. So you could do, I mean, the most common one, depending on if you're doing
I have the page actually. I can go through it real quick if you want.
Yeah.
Because I was actually looking at the vault earlier. There's 1, 2, 3, 4 different plans. If you go to BYOBvault.com, the lowest one is $16 a month, and the next one up is $41 a month, and then the family plan is $60.
That's if you pay annually, though, Shauna. Click that little button to go to a monthly.
Oh, okay. Yeah, so go to BYOB Vault, and there's 4 prices on there. I guess technically 8, depending on the mode of payment, and then.
Yeah, the main plan to manage policies, velocity banking, everything would be $49 a month. Or if you did annually, I think it works out to be $490 a year. And then you save, it's like saving $8 a month.
All right, love it. Francie is saying, do they stay available on YouTube for a while? Yeah, all the webinar replays and most of the videos are on there indefinitely. And then Christian Omar is saying, Joe, my better half is really excited and ready for the gas pedal not to come up. I told her she better buckle up.
Yes.
That's so great to hear. I think back to several years ago when I was working with Christian and trying to help him get started. I moved some mountains for him, and then it was just not the right time for him to start after all. And so he's kind of been in and out some for a while, and he only just got started with his first policy this year. And so it's so awesome to see him like just full speed ahead. Yes. Love it.
Yeah. It just didn't happen yet, right, Linus? He kept at it. He kept wanting to do it. He was solid. I mean, he's talked to everyone on the team. Like he's awesome. He's supporting. He's around the route. He's around the campfire, folks. So Christian's coming. He's listening to all the webinar. He's constantly learning. He's constantly sharpening his saw. Something to kind of watch and do for yourself if you're really looking to make changes in your life. So good example.
All right. Dino, I did read your email today, actually, saying, do you help here in the UK? Can you guys answer that question?
Yeah, I don't think the UK has whole life insurance policies. I'd have to do another search to find out, but I'm almost certain I've looked before. So I got a good video. I'll put it in the chat for you, Dino, on how to use IBC outside of the USA. The only thing you won't have is the actual policy to run it, but there are other ways to do it. And I'll give you that video that shows you how to do that.
All right. Shane is saying, Jose called me yesterday for the next PMC Money Tank, which is probably in Atlanta. I'm curious if you've been to the Mike and Mike house walk and what it entails. So like the bus tour thing with the Mike and Mike's. I have not been to theirs specifically, but I'd love to.
I'd love to too. Yeah. So, I guess the answer is no.
All right, so here's that outside the USA.
I've been sending that video. Well, I sent that video a lot in the first year because there's a lot of people coming through that were from other countries, UK, Australia, et cetera, et cetera. So,
yeah, Australia definitely is a no-go. UK, I don't think it's either.
No, they're all no-goes unless you're in the US or Canada, as far as I know. So,
I've heard Africa has policies.
Oh, nice.
From Nigeria?
Yeah.
Some prince? Send me $1 million bucks.
Brian.
Sorry, a lot of questions are coming in real fast. I want to hit this one personally. So Bunny B883 is saying, how much in commissions will I give up if I open a whole life? Say I start with 10,000. So I had actually looked up in this, and I want to reframe this whole mindset around commissions. So in whole life insurance, the agent isn't optional. They're essential to helping the client understand, maintain, and actually use what they've purchased. So the commission isn't just a payment from the carrier to the agent for acquisition. It's an investment in the relationship with you and making sure that you stay with this policy because the carrier wants trust-based relationships. So the agent, any agent that is going to become the face of that policy and the person that explains options, helps troubleshoot issues, and reinforce the value of staying the course. So client satisfaction equals policy longevity. And carriers know that when clients have a human guide, like any of these people on the screen, someone who explains how the policy works and when to use it, there's that trust that the carrier can stabilize their actuarial planning. And the actuarial planning is how the life insurance use math, statistics, and long-term forecasting to make sure that they can pay all future death benefit claims, maintain guaranteed cash values and dividends, stay profitable and solvent for decades. And actuaries are the professionals who do this planning. They look at how long people typically live, how often people cancel policies early, how the economy is doing, and how much cash value is building inside of these policies. So with all of that said, which I know is a lot, they build long-term models that help the company plan how much money they need to set aside reserves and how much they can safely pay out over time. Why this matters for whole life, and I'm getting there, okay, is whole life insurance is contractually guaranteed to pay out on death benefits and to make sure that they have stable long-term clients. So if too many people cancel policies early or stop paying premiums, it messes with their projections. And that's why the agent's role is keeping the client educated, exactly why we are on the screen right now, and educated and committed and actually are part of the company's success. So I'm not an agent, but I'm going to crusade for them right now. So if an agent can help you understand your policy, stay committed and use it, we're helping keep that giant promise jar that the insurance companies are going to do what they say they're going to do for all the families that are going to be benefiting from these death benefits. That's why the carriers pay commissions. None of these people are selling you anything. They are helping with the math and the security for everybody who's going to own one of these. I'm going to stop there because I'm clearly passionate about this.
I love this so much, Shauna. Thank you. I feel like we should all stand up a little straighter, get our chins up, be a little prouder, stronger. Like that was Shauna for president. Let's go. You heard it here first.
So that said, you are paying less for any of these people on the screens than you would to anybody else. So you're actually getting more for less when you work with us. So if anything, it's just value add, value pricing. All right. Diana was saying her agent's name is Barry and he's a great guy. And the address was 10640 Clarence Center Road, which I remember that address. Okay. Craig is saying, do you recommend now using all of your cash value instead of only using 85%, so that if my Mexican cartel investment gets blown up and I can't afford to repay, this way the dividends should cover interest?
It's a good strategy.
Yeah, it's more about not using all of your available liquidity just to be able to have a reserve for unexpected scenarios. When you say doing it that way so that dividends can cover interest, whether you use your max loan or not, it doesn't affect the dividends.
And I think if I was my emergency fund, I'd rather have it inside of a policy than a bank. So I like that 85% rule.
Make your own rule too. Like I really like that we're even having the conversation around rules, right? Like Joe says, if the money's not in motion,
Yeah,
not making money, right?
exactly.
And then I looked at, I've been putting the pedal to the metal here between investments and investing in the business, where I'm like, there's not really a huge liquidity fund. There's some, but there's maybe not as much as I'll be comfortable. So whenever you have that discomfort, it's going to make you feel a little uneasy. So you got to kind of set what that barometer is. Like Craig Yenny's really good about sharing this, but apparently his technical issues kept him from coming back. But there's a really good amount that's going to be personal. Like how much of a liquidity fund do you need available to feel safe? Right? Like Craig has good guidelines around that. I have my own now. Like he made me aware of it. And I'm like, wow, I am massively overcapitalized in some areas. So does that help people a little bit?
Yes, and I think they kind of came from that the thought of like that the policy loans are there if you can't keep your policy alive, and I do feel like you should keep that buffer there. And Brian started out with saying that he's kind of always got an emergency fund for something.
Yeah, for that tractor that just broke down, I think something like that, something of one of the machines in Oregon, or Idaho.
His for snow preparation.
Yes. He loves the cold.
Sorry, there's a lot of questions in here tonight.
You better fly. Let's fast. What's it called? Rapid fire them.
I hope this isn't true. Kevin said an agent took 60% of the price of my house sale and said it was standard. I had no clue. I don't know how that works.
They'd be in jail.
That's what I think. Predatory.
No.
Cashy.
Okay, Sarah's saying, hi, just got married and house is still in just my husband's name, only with no mortgage. I have a bunch of debt I want to pay off faster. My name needs to be added to the deed first to do a HELOC, correct?
Yeah, but maybe what you'd want to do, Sarah, is like an all-in-one, because that way your bank account would be attached to your HELOC. Joe, do you want to hit that? Because I think if they're looking at a HELOC in this case, like that'd probably be way better to do a first lien, wouldn't you think?
When they do a HELOC at closing, they can add her name to it.
Yeah, I mean, either way, they'd be able to add it.
Yeah.
Well, she's saying there is no.
Get rid of your debt.
She's saying there is no mortgage, so they don't necessarily have to go with an all-in-one. Any HELOC is going to become that first lien.
That's why I was saying, like, there's no point in not doing the all-in-one. You know, I mean, I guess you look at both options, but the all-in-one would give you the ability to use that bank account to help reduce your interest on the loan.
Oh, you're referring to the sweep account, maybe?
Yeah, sweep.
Yeah.
Sorry.
Okay. Yeah, I got you.
Yeah. I don't know if there's a difference in closing costs, but
There would be if it was a second lien or a first lien.
yeah.
You recognize that name that just popped
I
up?
do. Shout out to Tony Leon. We just spoke with him earlier today. It was a great call. We showed him how IBC can what it can do for his financial situation. He was fixing to start reading Nelson Nash's book. Looks like I got all the way to chapter 6. I love it.
Wow.
Right. He's saying chapter 6 discusses don't go out the back door, i.e. don't steal. Can you explain
Don't steal
how
the peas.
that applies to loan repayments on your policy?
Got to read the chapter again, bro. Got to read the chapter. No, we'll answer. That's what it says in the book. It says if you don't get this, and it says it like 5 times in the book, if you don't get this, you got to go back and read it again. So, but anybody else want to hit on why we don't steal the peas and why it's important to pay back the loans?
Well, it's just like if you have a business and you have a rental properties, are you going to charge a different rate for a third party person, a tenant, than you are going to be like your best friend or your family? Because if you charge a different rate, then you're actually not getting the full value of that asset. It's the same thing here. If you are charging yourself a different rate than you would a client over here, you're not actually seeing the full picture. You're not getting the full benefit out of it. So it's kind of like the bigger picture thing here. But if you have a business where you have groceries and you don't pay the full amount for those things, your business is not going to do as well and not going to look as good on paper. That's not a good business practice. And it's kind of hard to explain it. I've done it before where where I was doing real estate and I was lending myself my own money. And I realized that if I charged myself a different rate than a hard money lender would, it kind of screwed up the entire thing, even though I was the one receiving the benefit. So I realized if I'm going to lend myself my own money in a real estate deal, I should charge myself the same exact rate as a hard money lender, because then everything works better. And so just personal experiences is that treat yourself the same way you would treat a traditional bank or anybody else.
With the loan repayments, it also reverses the interest that you're paying. So,
Yeah.
Depending on how much the loan is and depending on how much you put back, you can turn that into velocity banking and spin it around that way too.
Yeah.
Joe, what do you mean when you say spin it around? You love that phrase.
By changing the way that if you just do a loan at $400 a month and you have $1,000 in your hand, why don't you take the whole $1,000 and put it back into the loan? You can spin right around 2 days later and take it right back out. But now you reverse the interest for that amount of time by doing 2 payments instead of 4. You did 2.5. So maybe you might not need that entire 600. You might only take out 200. So you left a little bit more in. What did you do? You just saved a little bit more in interest. You're doing velocity. You're putting more in than what you said you were. And it's still accessible. As soon as the loan repayment goes, it spins right back over to cash value. In a couple days, you can utilize it again. You can turn it right into, more or less like a revolving line of credit if you wanted it to.
I've actually learned that in the last probably 6 months, I was just doing what I think a lot of people do, is I would take the amount of my, like a loan for my investment, I'd put it in an investment, I would make interest off of my investment, but I was just like taking that money and just like kind of like living off it or keeping it in my regular bank or whatever, like interest money from that was, because my mentality is I'm going to take that whole amount when the principal comes back and pay back that loan. I just started really, really realizing how inefficient that is. And a couple of ways I've looked at it is what Joe was just saying, is if you start putting money backfilling that loan, you're paying less interest. What happens if I fill, and me and Craig have talked about this, is like, this is the new logic that I have too, is what if you really did wealth build? What if instead of that new money that I just created, that new line of interest that I never had before I only had the paycheck that I went to work for, why do I have to start using that now? What if I just put that back in the loan? And what happens that day that I can't pay that loan anymore because I paid it all back? That's great. I pull over there. And then let's say the principal from my interest comes back. That's a whole new check that I have that's huge and whole, and I pretty much doubled my money. I can go start a new policy. It's just a way to automate build wealth. And I will say, as somebody who works here, I didn't really see that until the last 6 months. So that's my new strategy, is don't freaking spend the new paycheck, put it back and double your money or whatever.
That is spot on. That is it. Exactly how you build your banking system is that it takes diligence and takes, being methodical in how you do it, but it has massive rewards at the end.
And like Joe said, it's there whenever you need it. Like I just had to get really expensive tires, and I'm just going to dip in for a loan, and I'm going to, like, all the things is there whenever you need it for whatever you need.
Dude, you should see the mutters she put on her SUV.
Oh. They're actually all seasons, but I looked at them too, and I was like, wow, those are beefy.
Nice.
All right. We only have we had more questions than we have time left. So we will just have to get to more questions here soon.
Those tires would probably be considered obnoxious around here on a credit card.
Safety around here.
Dino saying, I'm researching setting up a family investment company, FIC. We have whole life policies with profits here in the UK, but you indicating a BOLI needs a specific structure. I've not dug into that deep yet. And then I'm watching the bullion markets and stacking silver, diamond hands. Diamond hands is probably an emoji. Can I put this in a structure and borrow against it for liquidity and not sell?
There are companies that do that. Yeah. If you got silver or gold, there's companies that it's kind of like a margin account against your holdings. You just got to find a company that will actually give you the leverage on that. And the other thing too, if you have whole life policies in UK, please email any one of us one of those policies. Please let us look at that, because I've never heard of a whole life policy in the UK. And if that is the case, well, I need to do a video on it for sure.
All right, and then we'll just end with this question. And sorry, guys, we didn't get to all of them. But Dubsy is saying, on this topic, is there an available calculator to figure out how much the loan repayment per month should be? I just started, so I only have $2,500 available to pull. Yes, there is a calculator called the Vault, right, guys?
Yeah, the Vault. But I mean, you just remember, if you're creating your own banking system, I mean, you create the loan terms, not with the insurance company, but you create your own loan terms. So when you take a loan out and you use that to whatever, buy a car, when you repay yourself back, when you set that up, it can be basically anything you want. I always just mimic what the dealership or a loan company like Ally would charge me, but the Vault does all of that. There's literally what's called, there's several tools. There's a debt blaster tool, which will use the policy and allow you to pay off debt. There's the gains projector, which will allow you to use it for investments. And then there's the major purchase, will allow you to use it for buying any major purchase. And it will show you the mathematics behind it and allow you to use the loan officer to design your loans and the repayments and look at different scenarios. So BYOB Vault.
Yeah, and that sounds like a debt blaster, like the lowest one. You can probably go with that lowest option.
That's great. But then also there's just like a simple option can also be to just do a Google search for a online loan calculator. Those are also
that's how I used to do it. Yeah.
Thank you.
And then I do want to have just this one last question here for you, Joe, probably, is Jake saying, I have a HELOC and it gives a principal and regular payment option. I put my income in every week. Is it necessary to make principal payments, or does it matter?
If you're putting your paycheck, the entire paycheck in, you are making principal, because that should be more than the interest. And you're doing it 4 times a month, and your interest is only pulled out once a month. So you are performing velocity banking. If you're putting in paychecks for 28 days and then you're only paying your HELOC once and your credit card once, you're doing velocity banking by diminishing the interest that's actually owed to the bank, because it's on an average daily balance of 30 days.
Okay. All right, I'm sorry. I don't like leaving one person out. We're going to answer this as fast as we can. So Millie's saying, so do I have to open a policy under my own name for my own banking systems, or can I just do it under my grandchild? And does it make a difference if I pay my year up front?
Doing the annual premium versus monthly or whatever fits your cash flow, not a huge difference. It can be designed around that. So it's really just whatever fits your cash flow. As far as your other question there, there's kind of different parts to that. First, I would be looking at probably getting a policy on yourself. You're the older generation that's going to pass first. So just from the pure death benefit perspective, that's where coverage should be placed first. Sure, you can get one on your grandchild or grandchildren. They all need to be insured at the same time. But both are an option, yes. But you may want to look at getting a policy on yourself and your spouse and whatever older generations first, also from that, for that death benefit perspective.
All right. Thanks, Linus.
Sure.
All right. That's it, guys.
That's it. That's all. Thanks, everybody, for joining us for another episode of Ask Me Anything Happy Hour, and we will see you on the next one.